So in this recap video, I'm going to cover the gold market, and that is a long position that we took. Now, first of all, I want to show some similarities in just the setup, and not that it ever has to be a specific symbol. Oversold buys, choppy market, oversold buys, or what's known as a fade. We have two of them going on right now. One is in the New Zealand dollar versus US, which could also be executed on the New Zealand dollar futures contract. We have one in gold. And both follow through to profit targets. So that there's a few basic things we do at profit targets. One, they're proactive. It's like a finish line. It's like a sprinter running down the track and crossing the finish line. There is a ribbon waiting there that they run through. Well, that's what the first profit target is like. It's a price already waiting there. That price runs through. So it's executed by way of having a stop order. So when a price is triggered, it becomes a market order, and a part of your position, you exit. It could be as little as a third or a quarter or as much as a half. I typically will not exceed a half of my position. If you only have one lot, you're out, and that's okay. It's a winner. Pat yourself on the back, or as I like to say, jump back and kiss yourself. So that's number one. Number two is, what if you have multiple lots? Maybe you're trading the MGC micro gold contract, which I absolutely recommend for people who cannot trade more than one contract of GC, or say the YG contract. So if that's the case, what I would then recommend, once the trade is a winner, conventional wisdom tells us don't let a winner turn into a loser. And the way that I execute that concept is by moving from the risk-based entry to a break-even entry, which is typically going to be not at my entry level, but just a smidge, a point, a half a point below it. So I will place an order now to exit at my target, and then I'll move the break-even stop to just below my entry. So now if the market snaps back for whatever reason, I'm really not risking my capital any longer. I've done the two important things I have to do. One is I have to reduce my position size and pay myself. And in that, I am immediately reducing risk by reducing position size. And I'm immediately doing my number one job as a trader, probably number one tied with, controlling or reducing risk, is paying myself. So the question I get oftentimes is, Rog, how do we trail a stop? And that's also going to be using this data. This data is integral to what we do. There's just no two ways about it. It is superior to average true range, as many of you have found out, and it's very simple to use. On a daily time frame, if I have approximately 17 points of cushion, I can back off by 17 points minimum and place an order to exit. In this case, that's going to put me just below, as you can see, 1320, which locks in profit for me, which makes it a trailing stop. Because now it's not risking all my unrealized profit, only one daily price movement range's worth. So when am I allowed to transition to a trailing stop? Once I have one DPMR, or daily price movement range, under my belt. Or the closest really I would ever recommend getting is the 24-hour, because it is a daily time frame. The closest I would recommend is the 24-hour EPMR. I wouldn't get any closer than 1324. Well, I like the idea of a trailing stop below 1320. So utilizing the 17 points, subtracting it down to ask myself where and how much cushion am I willing to give the market, that suits me just fine. But really at this point, and in order to fulfill that, don't let a winner turn into a loser, you want to move your stop at worst to a break even. But in this case, you do have the latitude to use the DPMR, the daily price movement range, of about 17 points, and really at this point be in a trailing stop scenario.